Welcome everybody. My name is JJ Fields, and I'm a partner here at FMB Wealth Management. As many of you know, we were introduced to DFA, Dimensional Fund Advisors, in the early 90s. And one of the reasons we were attracted to them was their academic-based approach. And over 25 years later, they still approach current events and everything they do with this academic perspective. And it is for this reason that I'm so excited to introduce today's speaker, as his role at Dimensional is to educate the public about Dimensional's focus on academic philosophy and investment philosophy. It is with this, I have the privilege of introducing Apollo Lupescu.
Hi, JJ. Thank you so much for the invitation to be here, and thanks to everybody for taking the time this afternoon to attend the webinar. And you know, to begin with, it's kind of crazy. We live in really nutty period. There's so much uncertainty in the world, and we have the election coming up. We have, we've had these civil movements lately. The fires here in California. There's so much going on, and a lot of investors are wondering, what should we be doing now? What's going on, and what's the right thing to do with our money going forward? So I'd like to touch on some of these things. Obviously, the pandemic is another big story that is on people's minds. And I want to start by taking a look at the election. I think that was the topic that is listed as the header, and I do think it's really important on people's minds. So the election, we have a few weeks left to the election, and what I'm hearing out there are some folks who are really nervous about what might happen after the election, whether it's the election itself, and whether it's the stability going after the election, whether it's what will happen if the current administration continues, what would happen if a new administration comes in. So there are quite a lot of concerns about the election, no doubt about it. What I would start with is just an acknowledgement that politics touches on our core beliefs, deeply held beliefs on our identity, and because of that, it is a very emotional subject. And what we know is that it's okay to feel the emotions, because that's what makes us human. On the other hand, it's also something that we have to watch out and be very careful as investors, because we don't want to make decisions that are clouded with emotion. What really successful investors do, and managers like FMB, what they do is really try to disentangle these emotions from investment decisions. So let's acknowledge them. And some people, are anxious about one thing or another. I think once the election comes, you'll find that, half the country roughly will be happy about the outcome and half won't be happy. But right now we're in the middle of it and everybody's unhappy. So at least in a few weeks, we'll have some people who will be content. But what we do know for sure from behavioral studies is that people who are on the winning side of an election tend to feel more optimistic about the future of the economy and the market. People who are on the losing end, they tend to feel more pessimistic about it. So acknowledge that this is a reality of what makes us human beings, and it's let's acknowledge it, but let's not make decisions based on that. So because we don't want to make decisions based on emotions, what is the basis? What are some of the key things that would help investors kind of cope with with this uncertainty today and look at the decisions going forward because of the election? And I'd say that there are two main considerations that I would point out. The first one is that when you look at investing, everybody has tons of information. Everybody has knowledge of the polls or what industry might win and what industry might not win. And there are certain probabilities attached to all of these. And because everybody has this information, all this, not just current data, but also future expectations are already priced into what we pay today for certain stocks. So the current prices that you see for any company reflect the expectations that market participants have about the outcome of the election, who might be a winner, who might not be a winner. And I think it's a really important point to make, because quite often people are looking at it and saying, aha, if this wins, if this win happens for, President Trump or for candidate Biden, then some companies would stand to benefit and others not. All of this is already known. Everybody's chasing it, and it's an incredibly competitive market. Right now, there are more professionally managed mutual funds in the US than actual stocks trading on the market. It's crazy competitive. And for every buyer, there has to be a seller. So what you have is a tug of war. On one hand, you have 1,000 MBAs from Stanford, and on the other one is 1,000 MBAs from Harvard. And that's what the playing field looks like right now. The second point that I'll make is that when it comes to an election, there is a lot more that drives the market than the election itself. We quite often want to know that the election will do one thing or another, and all these talking heads telling you what's going to happen. The reality is that there's so many variables that drive the stock market, and politics is one of them. But I would actually suggest it is not a primary one. And why is that? Because the value of a company in the stock market, the way it moves, depends on the profits of a company. When you and I buy a share of ownership into any company, what we get is a slice of that firm. And because we're part owners, we're entitled to part of the profits that the company makes. So the value of a stock comes from the profits they expect to make for years and years down the road. And if you think of Facebook or Google or Nike, or you name the company, what do you think matters more for profits? The products they have, what the competition does, their strategy, how they execute it, or who's in the White House. And we'll see in the data that's exactly what we observe, is that politics is not the main driver. Elections and who's in the White House, does not matter. And that's the punchline. It does not matter who comes in office after November. Is it Biden or is it Trump? It doesn't really matter for you as an investor. Why? Because these companies in which we invest, they will try to find a way to make money in whatever state of the world will be. So because of that, I really don't think that there is enough evidence to say that we should make a move with our money because of the election. I don't think there's any evidence to suggest that because it's an election year, we should actually get out of the market or get in the market. I don't think we should make a move because we anticipate taxes might go up or down. None of these are reasons to make a move relative to the financial plan that FMB put in place for you. So, what are some of the data points that I refer to that might be helpful to kind of back up these assertions? The first one is that since 1926, when we have good data in the U.S. stock market, there have been 23 different elections. And I was curious, if you look at these election years, how different do these elections year look from any other year in the market? And to do that, we actually took the all these 23 different years and try to look and say how many out of these 23 different presidential election years did we see the market go up, and what percentage did the market go down? And I'll let you guess, like what the split in between is between the years when the market went down in an election versus went up. And it's pick a number. What we found in the data is that out of the 23 different presidential election years, 19 out of those 23, the market actually went up in that election year, and it's only 4 out of the 23 when the market went down. So being an election year actually doesn't say you're going to be worse off than in any other year. In fact, the average, the simple average of these election years has been about 11.3% growth in the market. Not vastly different from a non-election year. So being an election year, it doesn't really seem like like it's a really scary thing, because we did have a lot more positive years than negative years. Now, it's also interesting that we did have these negative years. And I thought, is there something that we can learn? Are there lessons that we can learn looking at these 4 instances when the market went down in an election year? Is there a benefit there? So the first time that we saw this phenomena with the market going down in an election year is obviously 1932. And in 1932, it was FDR versus Hoover, and the market went down. But there was also the year when we're still in the Great Depression. yeah, we had an election, but we also had the Great Depression. And 8 years later, in 1940, once again, a negative year in the market. But there was also the year when Germany invaded Europe, and it became obvious that that would become a world war. And then it took 60 years until the next time we saw a negative year in an election. And by the way, these were polarized 60 years. This is not like milk and honey. Everybody was hugging each other. Not at all. We had big things. We had the war. Remember we had, presidential candidate being shot and killed. So there are a lot of things in polarization in these 60 years. And yet it wasn't until 2000 when we saw a negative year. And we did have the election. Remember that Bush versus Gore, it wasn't really obvious who won until he went to the Supreme Court. So we've seen even elections drag on for a while before we knew who the winner was. But in that year, that's when pets.com and a lot of the high flying tech stocks were also starting to decline in value. So yes, we did have an election, but we also have the beginning of the dot-com bust. And the last one, obviously, in 2008 with the financial crisis. To me, what's interesting is an observation. When you look at the 4 years when the market went down in an election year, it seems that in every single instance, there was something a lot bigger going on in the world than the election itself. And even this year, we look at 2020, we have a presidential election, but we also have the coronavirus, it's a global pandemic. And should we say that if the market was up or down this year, it's because of the election? Knock on wood, if the market does go down for the year, we're much more likely to think that this was, 20 years down the road, we'll probably look and say, well, there's a coronavirus pandemic that's kind of once in a lifetime type of event, hopefully. So it is interesting that being an election year does not mean doom and gloom for investors. It's not a scary thing. Now, with that being said, this is a whole year. When you look on a shorter term, specifically around the election, it is to be expected that perhaps there will be more choppiness in the market. There will be more movement in the market, more volatility, as it's called. And we've seen that in 2016. In 2016, the night the election was called, the market absolutely tanked overnight. Absolutely tanked overnight, and by the end of the first day, it went up. So there's a lot of movement right around the election. So the way that I thought about it is like almost like throwing a rock in a lake. At the point of impact, the ripples are quite big, but as you move away from the point of impact, they smooth out to the point where they don't really matter that much. And I think it's possible that we might have something very similar, very close around the election, whether it's a little before or after, maybe days or weeks. There will be some choppiness, but these ripples will absolutely smooth out because, again, the value of a company has to do much more with the profits on which they have control. So being an election year, I would expect some volatility, and we don't know which direction. I mean, that's a good example of 2016. If you had looked at overnight, it's like, well, absolutely, it's a smart idea to sell. By the end of the first day, it wasn't such a smart thing. So we don't know exactly how this fluctuation will play out, but certainly not a scary thing. The other consideration that people have, the other question around the election is that does it matter if we have a Republican or a Democrat in office? Having a president of each party, how much does that matter when it comes to market returns and what investors get? And for that, I've actually looked at in my lifetime. I'm born in 1969, and when I was born, President Nixon was in office. And during the 5 years or so that President Nixon was in office, the market dropped by about 3% on average per year during his tenure. And then for the couple of years or so afterwards, President Ford came in with a roaring 20% average during his time in office. And then if you fast forward and you look at the average annualized returns per year, this is the average return per year during different presidents. The first thing that jumped at me is that there is no clear trend. There is no pattern to say that having a Republican or a Democrat in office is better or worse for the markets. I just don't see it. And in fact, what has been on my mind a lot more is that even as we try to kind of box in and say, aha, if we have this president, the market's going to do this. In reality, I do believe that presidents should receive neither credit nor blame for what happened during their tenure in office, because sometimes it has nothing to do with them and they can't control it. I'll give you a few examples. If you look at President Nixon's time, what happened was there was a conflict in the Middle East, and that conflict led OPEC, the Organization of Petroleum Exporting Countries, to put an oil embargo against the US. And that led to a devastating 73-74 crisis. During his term, there was a transition from the gold standard to the current type of money that we have. So certainly a lot of things happening during his tenure, and nothing that necessarily could have controlled. When you look at President George W. Bush, he walked in just as the dot-com was going bust. 9/11 happened 9 months into his tenure, and then he walked off at the very bottom of the financial crisis. On the other hand, President Clinton happened to be there when these tech giants were formed, and they just took off. And talk about market timing, kind of walked off just before they started to go down in value. So, I don't look at this and saying, well, it's better or worse for the market. No, it doesn't seem to be related that much at all to who is in office, whether a Republican or a Democrat. Now, beyond that, some people are also asking whether tax policy matters, whether somebody who is more business friendly might have a different result on the market and investing than somebody perhaps who is more focused on social programs. And I think that's a concern, and that has different facets. So I'll start with maybe the obvious to me. What seemed pretty obvious is that there is no guarantee that a president with a tax-friendly policy mindset will necessarily lead to better market results. We did have President Reagan, and during the 8 years that he was in office, I mean, we had tremendous tax cuts, and the market did go up quite significantly. A dollar invested at the beginning of his term would have more than tripled by the time he left office to $3.24. So certainly great returns during those 8 years in office. On the other hand, President George W. Bush, once again, very business friendly, 2 rounds of tax cuts, some specifically to investing, long-term capital gains, dividend taxes. And yet during his tenure, a dollar invested at the beginning would have turned into 70 cents 8 years later when he left office. So again, tax policy doesn't really seem to line up with just what happens in the market. There are a lot more variables that come into play, and more so, even if you have a president who is known for social programs, that doesn't necessarily mean it's going to be doom and gloom for the market. President Clinton raised some taxes, but probably the best example is you look at President Obama with Obamacare. And yet during his term in office, a dollar would have pretty much tripled once again to $3.28, which is remarkably similar to what happened to President Reagan's terror. So whether you have somebody who's very business friendly or somebody who has Obamacare as a staple accomplishment, for the market, it seems that it can in both cases, the market actually rewarded investors over their tenure. So it is interesting. So I wouldn't look at taxes and say, boy, this person is going to come in with a tax policy. That's a disaster for the market. Not necessarily, because even if you have those, it might not lead to great results as we saw here. And then one more note on this. When we're thinking about taxes, this is not something new. Companies have had to deal with high tax rates for many, many, many years, and they figured it out. They had transfer pricing and they had ways to create offshore companies. They figured it out. Same with individuals. For the longest times, advisors have helped their clients with tax management, and those strategies are perfectly valid today. Perfectly legally, you can do loss harvesting. There are other things that advisors can do for their clients to certainly mitigate the impact of taxes, assuming there is a change in tax rates. And frankly, I I live here in LA, and whenever I heard tax cuts a few years ago, I was kind of excited. But then I realized that the tax cuts were basically a tax increase, at least for our family, because we could not deduct the state and local taxes. So it wasn't really a tax cut for us. It was a tax increase. It might have been a tax cut for corporations, for other individuals in other parts of the country, but for us, it was a bit of a tax increase. And once again, it's kind of hard to say. So it's a pretty complicated issue, and I would not tie that too closely to what the market does. So that's I think an important consideration. Now, tied to this, people are also looking and saying, well, what about Congress? Because Congress is actually the entity that allocates the money, that does the budget, that does tax policy in terms of passing laws on that. How much does that matter having a Republican or a Democratic Congress? What if the Senate goes to Democrats? What if the House continues to stay with the Democrats? What's going to happen then? Well, in fact, we can look back, and this time we can go all the way back to 1926, and what we see is a very similar story. It's a very similar story. And the story here is that irrespective of who is in control of Congress, I would say that the trend, the only visible trend, is for the market to go up and for the investors to be rewarded with capital market returns. So it is to me, that's the only obvious thing that I can say. We've had periods when Democrats were in control for a very long time, and the market went up. And we had periods when the Republicans were in control and the market went up. But in either case, it does not seem obvious that it was a smoother ride. Yeah, the market grows, but in both Republican, Democrat, or mixed, we did have some bumps. Right here, there's the 73, 74 downturn. Right here is the tech bust. So it's not like one party or another. Absolutely, it's clearly better for the stock market. Not at all. It does not appear to be the case at all. So to me, it's a great way to look and say, well, what do we know? we know that the markets will go up under each president or under whatever Congress we have. It's just not going to necessarily be a smooth ride, and there's so many other variables that will impact the market returns rather than politics itself. And one of the last things that I would touch is that people are looking at this and saying, well, perhaps if we actually look at the odds of somebody becoming president, that would help us determine if there is a particular sector or some company would stand to benefit from what is going on. And I think that's an interesting thing. And again, everybody's looking at that. So it might not, by the time you buy it, it might be bid up in price to the point where it's so expensive that it's not a good deal anymore. But I think more interestingly is, don't get carried away, because it doesn't always pan out the way you think. If you look at the current policies, the last 3 years or 4 years or so, there have been 3 areas that is public knowledge. Everybody knows that the current administration has been really forceful in supporting fossil fuel, coal, and steel. And yet, if you think about these are supposed to be the industries gaining under this of policy. And yet, look at Exxon as a company. Go check out. It lost more than half its value. You look at some of the coal companies who came out of bankruptcy, and then once again they lost the majority of their value. And even steel industry that was helped by the tariffs, it doesn't necessarily mean that it was a boon for investors. If you look at the company that bears the name of the industry, U.S. Steel, this is what the stock price looks over the past few years. There was a period when the market went up, and initially I might have been tempted to think that this is when the tariffs are put in place. But what's remarkable is that the tariffs actually came in place right here. There was a bit of a run up in the stock price for this company, but then ever since it's been a downward trend. We're losing the majority of its value, even as steel is an industry that is protected through tariffs, and it's a priority for the government. So again, I would be cautious, because either because these prices already reflect any possible winners, or because it might not pan out. Market forces and competition, what's going on in the world, might actually be much more relevant than the policies coming from DC. Once again, it's a reinforcement of the same thesis that election should not make somebody either excited or upset or sad about what's coming ahead, because they're not the basis. There's just not enough evidence to make it the basis of making a move in your portfolio. And perhaps to illustrate all this in non-election way, I think to me at least, the example that really brought it to life, and the story that brought it to life was a story around World War II, because that was probably one of the most devastating periods in our parents' lifetime. It was there were dark days. And I want to tie this into investing and how the doom and gloom might have affected an investor. So if you think of World War II, in 1936, we had the Olympics in Berlin, and you kind of see the way the world is going. And in 1937, what you see is that the market in the U.S. drops by pretty much almost as much as in the financial crisis. So big drop in the market. It lost more than a third of its value in 37. And we had a rebound in 38, but 39, 40, and 41, by the time the U.S. enters the war in December 1941, it was not a pleasant ride for an investor. So if we had a time machine and we would go and be in a dimly lit living room somewhere in the country, and you thinking out there as an investor, boy, 4 out of the last 5 years, I lost my shirt in the market. This doesn't look good. Millions of people are dying. Cities are being destroyed. And on top of that, the tax rate at the highest level was 90%. It is 37% today. It was 90% back then. There were differences in deductions and all that, but it's so interesting to see that the tax rate was 90% of the time. So if you're an investor with all these things going against you, the devastation in the world, the last few years of losses, the high marginal tax rate, you might be thinking like, boy, the investing in the stock market, that's like the last place that I want to be. Why would I ever touch that? And what's remarkable is that during the darkest days of our parents' generation, the stock market had an incredible run. During every single year of full war, with millions of people dying, the stock market had positive returns, remarkably positive returns, to the point where a dollar invested at the beginning of the war would have more than doubled by the end of the war in a short time. And it's remarkable. And you might wonder, like, wow, where does this come from? Well, it's actually a really important point that ties into what I talked about it earlier. When you invest in the stock market, you have companies who will try to find a way to make money in whatever state of the world we're in. And back in those days, they couldn't sell cars. So Chrysler and GM made tanks and they sold them to the army. Toy companies probably made bullets. That's what we're seeing today. The same car companies were making ventilators for COVID patients. Distilleries were brewing hand sanitizer instead of spirits because that's what it was selling. That is with us today. Airlines are switching from having passengers to shipping cargo. So that's the beauty of free markets. That's what really we're banking on. It's not just some hope that things are going to be okay. Not at all. I have a belief in free markets because these CEOs, these companies do have an incentive and, in fact, a duty to shareholders to try to make a company profitable. And even if they work in their pajamas out of their bedrooms, I have no doubt that the main goal is, how do I get this company back to being profitable? And us as shareholders will just be along for the ride. We don't have to go to work. They do it for us, but we're still owners in that company. So in that respect, I think that, whoever comes in office, that is not the main driver of the market. It's rather the companies themselves trying to figure out a way to make money. And think about this: Coca-Cola, McDonald's, Apple, Facebook, all of these companies, irrespective of who might be next in office, they'll mind their own business and they'll just make it work. They'll figure it out. I have no doubt about it. So to me, those are some perspectives that I wanted to share with you with respect to the election, and why, in a way, maybe put your mind at ease, because it is not as dark, as bleak as it might seem. It's rather something that we might have seen in perhaps in other forms in the past, and it's something that we're absolutely equipped as a country, as a society, as a free market to handle.
Apollo, that's fantastic. Thanks so much for all that insight. Clearly, a lot of analysis on everything going on, not just now, but what does it look like in the past. So we've got a couple of questions from clients and colleagues that have come in. So I'm just going to dive right into these. I'd love to hear your thoughts, Apollo. So first, you kind of just mentioned a couple of these companies. So here's the first question. It seems the world is changing and the crisis has cemented the dominance of a handful of very large tech companies. You mentioned Facebook, there's Amazon, Apple, Microsoft, Alphabet, which is the parent company for Google. A lot of people think these companies are going to dominate going forward, given their scale and outperformance recently. So why shouldn't investors just focus on these companies?
Yeah, that's a very insightful question, because we have seen these five companies, the Facebook and Apple, Amazon, Microsoft, and Google Alphabet, really have tremendous performance. In fact, if you look through the end of August, on average, these five companies have given investors a return of about 49%, almost 50% return in a pandemic through the end of August. So really tremendous results. So it makes people think, well, there doesn't seem to be much of a downside. It seems like they're very solid companies. They will continue to dominate because, look, we change our shopping habits. We're much more online now than ever. We are using these products. It's not like I don't know what they are. Of course, every single one of us uses every day some technology product. So that might be the future. So why not put more money into those? And we've looked at that. It's a sensible question. I think that to begin with, I think that you should own these. I don't think that you should not own these. Absolutely, you should own these. I think the question is, to what degree do you want to own them? That's a different question. And there are two different schools of thought. One is, let's concentrate and put a lot of money into them, and the other one, well, let's keep the portfolio more diversified. And I think what our belief is that you're better off holding these companies, but be a little bit more diversified. In other words, don't put all your money into these companies. And I'll tell you why in a second. The reason that I think you got to be careful is that that these companies might continue to dominate. In fact, when we looked at companies going back to the 1930s and what happens when they get to be this big, it was quite fascinating, because once a company gets to be in the top 10, it seems like quite often it continues to stay there. What you see here are the top 10 companies going back to 1930, and AT&T, for example, it was the largest company in the 1930s, and it was a technology stock at the time. Telephony was a big deal. Being able to pick up the phone and call somebody, that was high tech. You had GM with the cars that they were making. You had GE, obviously. So DuPont with the chemicals. So that was the technology of the time. And AT&T was on top, the largest company for 4 decades, 40 years, and another 3 decades in the top 4. So you have 7 years of being in the top 4. So certainly this could last a long time. Exxon, that we talked about, Exxon started being in the top 5 back in 1930, and he was there for 90 years. And the last decade, 10 years ago, was the largest company in the U.S. market. Today, it was actually kicked out of the Dow Jones. So it is interesting that once a company gets to be this big, it is quite possible that it continues to stay big. And it's possible. It's possible they might not. We have certainly a lot of examples like Altria and Intel and Procter and Gamble. They were there just for a little bit of time, or Time Warner for that matter. But I want to reframe the question, because what we want to know as investors is not whether or not these companies will continue to stay large and dominant. I think the question that we should think about is, are these large dominant companies also great investments going forward? Because investing is about now and the future. So the question is, once a company gets to be this big, what do we see happening with the returns they deliver to investors? And when we look at the data, what we saw is that as the company gets large to reach this top 10, they do deliver remarkable performance to investors. What these numbers show you is not the return that they gave investors, is the return they gave over what the general stock market delivered. So if the return of the market, for example, was about 10%, on average for the previous 10 years, these companies returned 20%. Over the previous 3 years before they got in the top 10, it was a 34% return or so. So before they get to be in this club of top 10, they actually shoot the lights out. And in fact, that's necessary, because to get so large, the price has to go up. So they get more and more expensive. The price goes up and up and up. They reach the top 10. Now, once they get there, what do we see? And what we see is, then you fast forward 3 years or 5 years or 10 years, what you see, it's a very different experience for investors. Over the subsequent 3 years, they still have a little bit of outperformance relative to the market, but over the next 5 years, and particularly over the next 10 years, they actually tend to quite significantly underperform the market as a whole. So it's so interesting that the great performance is, once they get to this point, once they get there, it's not necessarily obvious that they will continue. And why is that? Well, in some ways, it's quite intuitive. The first intuition is that once you get to be so large and a mature company, in order to attract investors, you don't really need to offer great returns, because, the safer the company is, the more mature, you don't have to pay much in interest rates. You look at the bond rates, you look all over that's just, think of individuals. When you're 50 years old and you have a track record of paying bills, well, you're going to pay a very different interest rate than the same you when you're 25 years old. So to me, it is maybe the cost of capital for these companies changes. But the other big thing that is quite intuitive is that it is harder for them to grow. They eventually run out of steam, because how easy it is for a company like Apple or Amazon to double in size, or McDonald's or Facebook, you name it. It is very, very hard to actually grow and sustain the same growth rate. In fact, there's a knowledge out there that if these companies continue to grow at the same rate over the short term and the near term, they will actually be almost as much as half the value of the entire stock market, these 5 companies. So certainly not something that is likely to happen. So that's I think that's been on my mind, is that it's great that we've had them, but I don't want to concentrate too much, because looking forward, that doesn't necessarily mean they'll have the same great performance. And in fact, what I want is the next Apple, the next Amazon, the next Facebook, rather than get stuck in the past and say, well, that worked out. Great, we had those returns. Now the question is, going forward, what makes sense? And to me, absolutely makes sense to hold them, but the percentage in which you hold them is the key insight here. And I would say it has to be a diversified portfolio, more so than concentrating into a handful of these stocks.
That's fantastic. Yeah. Even recently, the past couple of weeks, they've also had price volatility as well. It's not just diversified portfolios or small caps that have experienced price volatility. They've seen them recently too. I got a question about, yeah. So we got a question about something a little more maybe pertinent to today, what we're experiencing now. So I think March 23rd was when we saw, maybe call it the short-term low point in the market for 2020. So the question is this: after 5 months of straight gains, there's a sense among investors that the market is overly optimistic, and when reality sets in, we're in for another big drop. Are traders oblivious to these signs? How is the market considering all this uncertainty? If we see a drop in the market or higher volatility in returns, are those signs something is wrong in the market?
Yeah, no, it's a very good question, because we never know. They're like Europe, and they're going through a second wave. If it is a second wave, knock on wood, hopefully not. So there are a lot of things that could happen. There are a couple of perspectives here. The first perspective is that the value of a company really is dependent on the profits that they will deliver to investors. And over the past few months, even companies themselves who used to offer guidance on their profits stopped doing that just because they don't have visibility. So to a certain degree, investors are kind of flying in the dark, and right now they're trying to make some estimates that are very, very noisy. So I wouldn't be surprised at the volatile returns, because you're trying to make a projection of profits and cash flows and earnings for companies, but it's not really any solid basis. It's pretty much all over the place, and it's not obvious to me that investors really have a good grasp on what might come next, and that uncertainty might lead to more volatility. Nothing is broken. In fact, it's a sign that the market works. It's really trying to price something that's very hard to price in. Now, on the other hand, I also want to kind of remark on this notion that the market's doing so well and it's going to actually maybe not do very well going forward. Here's the way that I think about this. When you look at the market, I'm going to use the S&P 500 as a way to describe the market. When you look at the market, you see that through the end of August, it was up about 10%. And certainly to a lot of investors, they say, well, obviously there's got to be a pullback of some sort. What's interesting is that the way we define the market is the S&P 500. So these are 500 companies roughly that are in the S&P. But if you look at the largest 5 companies there, the ones that we mentioned, and these are the Apple, Amazon, Microsoft, Alphabet, and Facebook, the returns, the average returns of these 5 companies have been incredible. They've been about 50% in 50% over since the beginning of the year through the end of August. And what's remarkable is that they carry about a 24% weight, meaning that 24% of the value of the S&P is in these 5 stocks, who are really the super high flyers. Now, what about the rest of the 495 or so companies that might be in the S&P? When you look at the average return for those stocks, it's actually a negative. And what's fascinating here is that you have a handful of extremely large stocks that have done tremendously well, and they're lifting up all the boats, but it doesn't mean that the stock market as a whole is flying high. Not at all. It's a handful of these very large companies that happen to be at the right time, at the right place, to not only, I wouldn't say nefariously take advantage, but they're, somehow they were able to navigate this, and they provided services that we needed now, and they went up in value. So to me, it's be careful, like the market's flying high. There are some companies that are doing well, and that lifts up everybody, but there's a big dispersion. There's a very big dispersion between what happened in the market in terms of returns. If you look at some of the performance, and the really good performance in the S&P, and this is through mid-August, well, it turns out that it's not even the tech company. It's not like new economy, it's the old economy. Boston Beer actually outperformed Amazon, did better than Amazon. Tractor Supply outperformed Apple. And why? Well, perhaps we might drink a little more beer at home. We all use Amazon. Tractor Supply is a big deal. We have a colleague who orders parts every day because he's on a ranch and he's all alone there. Clorox, obviously, I'm not need to tell you why Clorox is a great buy. And then, UPS, we're all shipping that much. We're all doing home improvements. So perhaps, there is a reason that some of these stocks are up. And what it is, it's a shift in the way they used to spend money. I used to fly pretty much every week. And when I flew, I got on a plane. Well, airlines are not longer doing very well. I used to stay in hotels, and that's no longer the case. And, when I got off the plane or woke up in the morning from a hotel, I used to get Starbucks, not the case. Don't take trip to Disneyland anymore. And certainly not a lot of cruising happening lately. So to me, when I look at this, it seems that not every stock is doing well. There's a dispersion in returns, and the ones that are doing better than others, perhaps there's a reason, and it's not as disconnected from reality as it might seem.
That's great. Okay, thank you. Follow up on that, kind of related to the same topic is given the perspective that you just kind of laid out, Is there any justification maybe for going to cash for the short term and avoiding any type of volatility in the next couple of months? Would that make sense? Or for people that are approaching retirement or in it, kind of protecting that hard-earned nest egg, so to speak?
Right. And that's a very, I think a lot of people would like to know, should I be in the market? Should I be out of the market? How do I think about this? And here's a view that I have, is that I've tried it myself, thinking about that perhaps it's good to sit out, stay this one out, come back when things calm down. And there are a few lessons that I've learned. I mean, the first big lesson that I learned is that whenever you decide to get out of the market and say, I'm going to sit out, you have to also decide, when do you get back in? And the idea is to know when to get back in at a lower price, because you don't want to basically sell at 100 and come back and buy in 120, because, buying low and selling high, it's not exactly successful investing. So you need to know when to get back in. And the issue that I found is that when you don't know when to get back in, that actually creates a lot of uncertainty, and nobody knows precisely when to make these two correct decisions, because you have to know not only when to get out of the market, but also when to get in. And that's the issue. It's not just getting out. When do you get back in? And I'm not aware of anybody who can consistently make those two correct decisions. The second thing that I learned is that, particularly for people who are closing to retirement, is that, or anybody for that matter, is that not knowing when to get back in the market. What I found on my own experience is that the stress of being invested in the market is very quickly replaced by the stress of being out of the market. Because, when you're asking Danny about this stress, I had a very, very similar set of questions coming in at the bottom of March, at the top of, towards the end of March, when the market was bottomed out, and people are saying, oh, maybe I should sit this one out for a few months because it just doesn't look good. I've already lost some money in the market. I don't want to take any more, painful losses. And I do know some people who basically just went and did that. The problem is that one of the things that I've heard over and over, they would call and say, when do I get back in the market? Because I'm not recouping my losses. Everybody seems like it's making up except me. And the issue is that at the time, it seemed to make a lot of sense. Boy, the market's obviously going to go down more with the pandemic, and yet it's staged in a remarkable recovery. And that was incredibly stressful. So I would say that for retirees, that might not be the best strategy. I would actually caution against doing that, because there's so much risk to begin with in the market. To add the more risk, I don't think it's worth it, because there are ways in which you can actually mitigate market downturns as they happen. And the first thing to understand is that if you invest in the stock market, the nature of the stock market is to fluctuate. Over the long run, the market has grown at about 9 to 10% per year on average. That's the long-term annualized return. But over the past 93 years, I don't think that we've ever actually had the market return, the actual average in any one year. From year to year, it looks something like this. It's a very choppy ride. It's a bit of a roller coaster. It's like Goliath or Superman at Six Flags. So it's a ride, but same with a roller coaster. Even as your stomach is turning, you're better off staying in your seat rather than jump out in the middle of it. And for people who did, it's an incredibly rewarding ride. My dad is born in 1926, which is the date we have good data in the market. And we have this book called The Matrix Book, which is a fantastic resource. It's a big book of numbers and encyclopedia of investing. And what I found is that if my grandparents had put $1 in the stock market, by the time my dad turned 93, he's actually going to be 94 tomorrow, that dollar would have grown to about $9,200. So really a significant growth in the market in my dad's lifetime. So without a doubt, this is a very, it's a very rewarding ride for a stock investor, but it's also very bumpy. And when you ask him, Danny, what can you do to protect yourself? I would say that probably the most effective way to protect yourself is not put all the money in buying ownership in companies, because the fluctuating profits means the market fluctuates. But rather what you can do is you can lend your money to corporations and the government. And there's a contract in place that specifies an interest rate that you'll receive for how long. And at the back end, you get your money back. That is called a bond. And if you had given your money, let's say to the government for 30 days, it's called a 30-day treasury bond, over the past 93 years, that has never been a single negative calendar year. So always stay above water with your money. And the other good news is that you stayed ahead of inflation. A bond would have, inflation is about 3%. These bonds would have paid a little over 3% in return to investors. So if you need some stability as you get close to retirement, boy, bonds tend to do a very good job. And not only that, but it turns out that when the market drops, they also do a very good job holding up against the market drop. In April, as the market was down about 10% or so, these government bonds actually held up really nicely. And it's not just an aberration for this year. When you look at every single year when the market has had a significant drop over the past 20 years, in every single case, the bond portion of the portfolio held up really well. And at least that's the historical experience that we have. And to me, low interest rates, high interest rates, in those years when the market dropped, these bonds held up really well. So if you want to protect yourself, I think a better way would be to think about, what is my allocation between stocks and bonds? Now, it's easy to say, well, why not put more money in bonds? I'm okay with 3-4% if I don't lose money. The thing is, specifically for retirees, you got to be careful, because why is that? If you had put the same exact dollar over the same time frame and invested it in the safety of these treasury bills at 3-4%, that 9,200, which is the growth at 9-10%, pick a number. What would the growth of the same dollar over the same time period be? And that book kind of gives us the answer. That number is a whopping $22. $22, that's it. That's would have been the growth of the same dollar over the same time period. So bonds give you stability, but you ought to be careful, because you need to have some stocks, because even as you go into retirement, you're going to have a 30-year unpaid vacation unless you have health problems. It's quite likely that if spouses are retiring at 65, one of them is likely to live into the 90s and 95. So it's a long time planning, and if you're going to become too conservative, then it might actually create risk. So how do you know how much to have in stocks and bonds? Well, to me, the only way to know is to sit down with the FMB team and really have a financial plan that looks at your specific circumstances. How old you are and when you need the money, how much money you have, how much money you need. Do you have a pension or not? Do you have other payments, royalties, rent, and so forth? And only when you have all these pieces in place can an advisor suggest and recommend to you, okay, well, if you happen to be a baseball player, well, your income profile is different than a university professor, and this financial plan will take account of that. And I think that is so important, to have a financial plan that takes account of your circumstances. And once you balance these stocks and bonds, I think that the experience that you get is going to be a lot more smooth in a way. In other words, you're not shooting for the lights. You're not shooting the lights out. You're trying to go for the home run every time, but you have enough runs to win the game. And I think that's what this balanced portfolio tends to do in a way that he focused on things that he can control, rather than, hey, what's the market going to do? Who knows that?
That's fantastic. Actually, Apollo, that's a perfect segue, kind of as we're wrapping our time here today. Next month, we're actually going to be doing something similar to this, where we're talking specifically about fixed income and the interest rate environment today. I mean, that's a whole nother webinar. It could be a whole dissertation, right? So it's a perfect segue to our next event in October. So first off, as we're wrapping, I wanted to say thank you so much, Apollo, for joining us today. It's always a pleasure to have you present to our clients and our colleagues and share all your experience, wisdom, and research. So we're really grateful for that. So for everyone who participated today, thank you for carving out some time. We know life is super busy, so we really appreciate that you take an hour to spend with us. For clients and everyone else, quite honestly, if you have any questions or concerns or follow-ups after this webinar of how this kind of next couple months or next couple years or next 30 years or whatever it is fits into your financial structures, please give us a call. We'd love to talk with you through that and how this kind of prepping for the next season of the election, how that fits into all of this. So like I mentioned, we focused a lot on stock stuff today, and next month we're going to focus on kind of fixed income interest rate environments. So with that, Apollo, again, thank you so much. Thanks for everyone for joining us today. We look forward to seeing you guys soon, hopefully in our office. Otherwise, we'll see you on the next webinar. Thanks, guys.
Bye.